For this session, we will talk about your income taxes in view of financial accounting. So take away what knowledge you have with taxation and what knowledge you have with financial accounting. And we try to look into the blend of that taxation and financial accounting. So for this topic, we are talking about income taxes under IAS 12 or PAS 12. So just like your leases, PAS 12 is a mixed account type of standard. Why is it a mixed account type of standard? Because it provides for an asset and a liability. So in our income taxes, what we learn here is an asset portion and a liability portion. And what is the asset portion? The asset portion is known as your deferred tax asset, and your liability portion is known as your deferred tax liability. Now, what we need to learn in this particular standard or in this particular topic is when do we recognize deferred tax asset and when do we recognize deferred tax liability. So let's discuss now your income taxes. So to learn your income tax, we need to understand these two items, your accounting income and your taxable income. Your accounting income and your taxable income. So your accounting income is your income per your PFRSS or per your generally accepted accounting principle. So whatever you compute using your financial accounting as an income is known as your accounting income. Your taxable income is the pertinent items of your gross income under your taxation, which is subject to tax under our regulation. So using your Philippine taxation, whatever is the pertinent items of gross income subject to tax is your taxable income. Okay? So normally when we talk about your taxable income, these incomes are those based on your regular income taxation. So in your income taxation or your income taxes under IAS 12, you must learn these two types of income. First, your accounting income. Next, your taxable income. Now, in your income taxes, generally, what we do is we reconcile these items. We reconcile your accounting income and your taxable income because based on what you know, of course, there are different rules pertaining to your Philippine taxation and there are different rules pertaining to your PFRSS. Since there are rules that is different between accounting income and taxable income, it will result to inequality. Since there is now an inequality between your accounting income and your taxable income, we call this inequality as differences. Now, under IAS 12, this differences is known as either a permanent difference or a temporary difference. Again, for our income taxes, what we do is we try to reconcile your accounting income per your PFRSS and your taxable income per your Philippine taxation. This difference is brought by two items under your IAS 12. That is your permanent difference and temporary difference. So what we account really here in your IAS 12 is the difference. That's either permanent or temporary. Now let's take a look on what is the treatment of a permanent difference and a temporary difference. So the differences, as we said, can either be a permanent difference or a temporary difference. We start first with your permanent difference. A permanent difference is an item of revenue or expenses which are included in either accounting income or taxable income but never be included in the other. So for example, we have here accounting income and your taxable income. It can be included here, but not included here. It can be included here, but not included here. That's a permanent difference. Therefore, if we reconcile that, we cannot reconcile it in the future. It cannot be reconciled in the future. So this results to a permanent difference. So it cannot be reconciled in the future because it can be included here but not here, not included here but can be included here. Therefore, there will never be a time that there can be inclusion on both. Permanent difference further pertain to non-deductible and non-taxable items. So it can be non-deductible or non-taxable. So in short, it was included in your accounting income, but for taxation purposes, it is non-taxable and non-deductible. Okay? So normally, that is your permanent difference. Permanent difference happens if ever it was included here as a revenue. So as an accounting income, it was included as a revenue. But in your taxable income, it is considered non-taxable. Or in your accounting income, it is considered as an expense. However, in your taxable income, it is considered non-deductible. Okay? So that is considered permanent because you cannot recoup it in the future period, meaning you cannot claim it or we cannot get the same amount in the future. Permanent difference, non-deductible and non-taxable. What I want you to remember in a permanent difference is that you do not get deferred tax asset or deferred tax liability. So no deferred tax asset, no deferred tax liability in a permanent difference. Then we have your temporary difference. So what is a temporary difference? So these are items of revenue and expenses which are included in either accounting income or taxable income, but to be taxed or deducted in the future. So a while back in your permanent, we cannot really reconcile it in the future. Remember, you cannot reconcile this in the future because it is a permanent difference. In your temporary difference, for example, accounting income, taxable income. So now or currently, what we do is we include it here and soon it can be included here. What is an example of that? You can include in your taxable income now, but you will only include it in your accounting income soon. Okay, for example, you have your collections in advance. Right? So collections in advance, remember under your taxation, once you collect something in advance, it is considered already as income. So you include it now in your taxable income, but it will be included later in your accounting income. So what can you see? It is now reconciled in the future because they were now included both on taxable income and your accounting income. So what happens here is only a timing difference. So what is this timing difference? Timing difference on whether it is taxable or deductible. So now, as you can see, it is taxable. But in your accounting income, it will only be included in the future. Okay, so that is the timing difference. It can still be reconciled in the future. So both they are now included. However, in your permanent, as you can see, it can be included in one, but not on the other. Not included in one, but included on the other. That happens in permanent. In temporary, it can be included now in one, but it will be included or not included in the future. So there will only be a timing difference here in your temporary difference. So permanent difference, no timing difference. Because again, what happens is you will remove it at all. Kasi nga, you cannot reconcile it. However, in your temporary, you will tax it or deduct it in the future. And since you will deduct it or tax it in the future, then there can only be a timing difference on your recognition of your taxable and deductible items, both on accounting income and taxable income. Next, it pertains to future deductible or future taxable items. So as we said, the difference is because of your timing. So it can be a future deductible or future taxable item. Finally, it gives rise to deferred tax asset or deferred tax liability. So there is a deferred tax asset or deferred tax liability in a temporary difference. Okay, so let's take a look again on our initial formula. Our initial formula is accounting income until you get your taxable income. And there are differences here. We have your permanent difference, plus or minus temporary difference. A permanent difference does not give rise to a deferred tax asset or does not give rise to a deferred tax liability. But a temporary difference will give rise to a deferred tax asset or a deferred tax liability. Okay? So what you do is taxable income times tax rate. This is your current tax expense. Your temporary difference multiplied by your tax rate is your deferred tax asset or deferred tax liability. Later, we will learn when do we have a deferred tax asset and when do we have a deferred tax liability. Okay? Again, basing from our initial discussion of accounting income and taxable income, we will reconcile items on your permanent and temporary difference. In your permanent difference, there is no deferred tax asset or deferred tax liability because it pertains to non-deductible or non-taxable items. But in your temporary difference, this pertains to timing differences on the recognition of your revenue and expenses on either accounting income or taxable income. Therefore, this results to a future deductible amount or a future taxable amount. Therefore, we have here deferred tax asset or deferred tax liability. How to compute for your current tax expense? Current tax expense is equal to your taxable income multiplied by tax rate. While to compute your deferred tax asset or deferred tax liability, you just get for your temporary differences, you multiply it to your tax rate. Later, we will discuss when is it DTA or deferred tax asset and when is it deferred tax liability. Okay? So deferred tax, when is it deferred tax asset or when is it deferred tax liability? There is a deferred tax asset if ever the tax recoverable in future periods with respect to deductible temporary differences and operating loss carry forward. So if that is a deductible tax or temporary difference, we have a deferred tax asset. If it is a deductible temporary difference, we have a deferred tax asset. But if that is a taxable temporary difference, we have a deferred tax liability. Take note, the word used here is deductible, meaning you can deduct it in the future. You can deduct it in the future. Okay? You can deduct it in the future. So we're talking about your deferred tax asset, which can be deductible in the future. So since you have a deduction in the future, so deduction in the future. Remember that if you will have a deduction, this results to a benefit. Since you will have a tax benefit, you have an asset. Deduction pertains to a benefit. Since you will have a benefit in the future, you will have an asset. And what do we call that asset? Deferred tax asset. Next, deferred tax liability. It arises during a taxable temporary difference. So take note here in your taxable temporary difference, what we have here currently is a taxable item. Since you have a taxable item, it means that in the future, you have additional tax. Since you will have an additional tax in the future, it means that you have an obligation. That obligation is called a deferred tax liability. Okay, we go back. When do we have a deferred tax asset? This happens when there is a deductible temporary difference. When we talk about deduction, it pertains to a benefit, and benefit under taxes means asset. Deferred tax liability. It arises if there is a taxable temporary difference. If there is a taxable temporary difference, it means you have a future taxable amount. So, you have an additional tax to pay in the future. By meaning of additional tax, it means we have an obligation in the future. We call that a liability. Deferred tax asset, remember, arises from a deductible temporary difference. Deferred tax liability arises from a taxable temporary difference. Since it is taxed in the future, you have a liability. Since it can be deducted in the future, you have an asset. Clear? Deferred tax asset and deferred tax liability. Now, what are the rules as these temporary differences? So, the first rule that we will discuss is if accounting income is greater than taxable income. So, our accounting income is greater than your taxable income. So accounting income, taxable income. So you need to equalize them. So meaning accounting income, let's say, is 900,000 and taxable income is 700,000. So to equalize them, what will we do? What we do is we need to deduct something that is 200,000. That's why currently what you will do is a deduction. Since you deduct this to get for 700,000, which is the taxable income, this deduction results to a future taxable amount. Future taxable amount. If you have a future taxable amount, we call that a taxable temporary differences. Taxable so taxable temporary differences. So take note, you deducted in the future, you deducted in the current year to get for your taxable income. So in the future, it is taxable. So it is a future taxable amount. If that is a future taxable amount, we call that as taxable temporary differences. Taxable temporary differences. We will have a deferred tax liability. Deferred tax liability. Clear? Okay. Accounting income is greater than your taxable income. Again, since they are unequal, we need to equalize it. So how do we equalize it? You need to deduct in the current year. If you deduct in the current year, you will have a future taxable amount. Future taxable amount results to a taxable temporary difference. That's why you have a liability. Normally, on the asset section, your books is greater than your tax basis. Next, on your liability section, that is equal to your accounting income is lesser than your taxable income. Accounting income is lesser than your taxable income. So your books is greater than your tax basis. Your books is greater than your tax basis. So what we do here in the currently is we tax them. We tax them. But in the future, we deduct them. So your accounting income is lesser than your taxable income on the part of your liabilities. So what we do, currently we tax them, in the future we deduct them. Since you will deduct them in the future, what will happen? You have a deferred tax asset. You have a deferred tax asset. That's as to your liabilities wherein books is greater than tax basis. For your assets, books is greater than tax basis. Let's look into your books. It's lesser than your tax basis. For your asset, your accounting income is lesser than your taxable income. So meaning, let's say your accounting income is 700,000, your taxable income is 900,000. So to equalize them, what will you do? You need to get 900,000, so you need to add 200,000. So what did you do in the current year? You add. So you tax it in the current year. Since you tax it in the current year, what will happen in the future? So you have a future deductible amount. Future deductible amount. If you have a future deductible amount, then you have a deductible temporary difference. Deductible temporary difference, you will get a deferred tax asset. Take note, taxable temporary difference arises deferred tax liability. Taxable temporary difference liability. Deductible temporary difference arises, then you have a deferred tax asset. Okay? So always remember, you need to reconcile accounting income to a taxable income. When do we have a deferred tax asset or deferred tax liability? So if the current year you decrease it, you have a future taxable amount. If in the current year you decrease it, you have a future taxable amount. If in the current year you increase it, you have a future deductible amount. If it's a future taxable amount, then we have a taxable temporary difference. We call that your deferred tax liability. If you increase it in the future, it will be deductible. We call this one your deductible temporary difference. You have a deferred tax asset. So how do we measure your current tax expense and your deferred tax expense? A while back, we say that once you get your taxable income multiplied by your tax rate, we have your current tax expense. But if we get your temporary differences, based on your temporary differences, if that is a taxable temporary difference or a deductible temporary difference, we have either your deferred tax asset or deferred tax liability. Okay. So in your current, just take note using the tax rate that is effective at the end of the period. So your tax rate is the tax rate that is effective at the end of the reporting period, while your deferred taxes is computed using a tax rate which is expected to apply to the period when the asset is realized or the liability is settled. So this is based on your future tax rate. Okay? Why? Since it is deferred, again, it will only be realized in the future. Therefore, it is proper for you to measure it using a future tax rate. But here in your current tax expense, since you are getting for a current tax expense, then you must use your current tax rate. And what is the current tax rate? That is the effective tax rate at the end of the reporting period. What is the future tax rate? That is the tax rate that is expected to apply when you will realize your asset and when you settle the liability. How do we present your deferred tax asset and deferred tax liability? So they are always non-current. So deferred tax asset is a non-current asset. Deferred tax liability is a non-current liability. So again, just like any other assets and liabilities, you cannot offset. Remember that. Under your past one, we said before that under past one, offsetting is not allowed. However, under past 12, you can offset if ever you have these items. First, if it's levied by the same taxing authority. So if you are a conglomerate, if ever conglomerate, you have different branches in the Philippines, in the US, in the Europe, yes, say. You have different branches there. So if you have a deferred tax asset or deferred tax liabilities coming from the three countries, you cannot offset. Why? It is not levied by the same taxing authority. Next, you have legal enforceable right to offset a current tax liability as against a current tax asset. When we talk about your legal enforceable right, there must already be a go signal coming from your authorities to offset the taxes. Okay? So that must be first approved by the BIR. Okay? So you just cannot offset it. You can only offset if it is from same taxing authority and at the same time that was already a legal enforceable right coming from your authorities or your BIR in the Philippines. Okay? So again, What do we need to understand here in your income taxes? We have your accounting income and we have your taxable income. And there are differences here. Your differences here are your permanent differences and your temporary differences. Permanent differences, no deferred tax asset, no deferred tax liability. Temporary differences, you have a deferred tax asset and deferred tax liability. There is tax asset if there is a future deductible amount or a deductible temporary difference. There is a tax liability if you have a future taxable amount or a taxable temporary difference. Okay? Let's have an example. Let's just make use of this one example. VC Company started operations on January 1, 2016. At the end of the first year of operations, VC Company reported pre-tax income of 2.4 million pesos. An analysis of the components included in this computation was a 300,000 non-taxable revenue and installment sales of 950, of which 600,000 remained uncollected during March 15, 2016. For tax purposes, income from installment sales is taxable only when cash is collected. Okay, so we have here 2.4 million. That is your accounting income. So first, permanent difference. It is a non-taxable revenue. If it's non-taxable, you need to remove it because it is non-taxable. If it's non-taxable, you need to remove. If it's non-deductible, you need to add it back. Okay? Add it back if non-deductible. So since this is non-taxable, you need to remove it. So what will we remove? The 300,000 non-taxable revenue. Next, we look into your temporary difference. The only temporary difference given here is the 600,000 uncollected. Sabi dyan, income from installment sales is taxable only when cash is collected. Since it is not yet collected. Not yet collected. Is it taxable now? Is it taxable? The answer is it is not taxable because it is only taxable only when cash is collected. So what do we have here? We have a future taxable amount. So it will be taxed in the future. If it is taxed in the future, what do we have? So tax in the future, it will be deducted now. So 600,000. We will not include this revenue, so we deduct it now because it will be taxed in the future, only when collected. Since it is not yet collected and you will collect it only soon, then it will be taxed in the future. Tax in the future, deduct now. Deduct in the future, tax now. Ganun yung nangyayari, di ba? Deduct in the future, tax now. Remember the current and the future. If in the future it is taxable, you deduct now. If in the future it is deductible, you tax now. So how much is our taxable income? Our taxable income is 2.4 million less 300,000 less 600,000. We have 1.5 million. So our taxable income is 1.5 million. Next, what is the income tax expense current? So when we talk about your income tax expense current, we just get for your taxable income multiplied by your tax rate. So what is your taxable income? Our taxable income is equal to 1.5 million multiplied by our tax rate, which is 30%. 1.5 times 30% is equal to 450,000 pesos. So the income tax current is 450,000 pesos. So taxable income times tax rate is the current income tax. How about the income tax expense or benefit? This talks about your deferred tax liability or deferred tax asset. If that is a deferred tax liability, we have a deferred tax expense. If that is a deferred tax asset, we have a deferred tax benefit. Clear? If that is a deferred tax liability, deferred tax expense. If it's a deferred tax asset, deferred tax benefit. So here, if you deduct now in the current period, you have a future taxable amount. So since this is a future taxable amount, we have a taxable temporary difference. A taxable temporary difference gives rise to a deferred tax liability. How do we compute again? The difference, you multiply it to the rate. So what is the amount of our difference? 600,000. What is the amount of our rate? Our rate is 30%. Then how much is the deferred tax expense or deferred tax benefit? We have 180,000 pesos. So 180,000 deferred tax expense because we have a deferred tax liability. Sir, what if we have both deferred tax asset and deferred tax liability? Then you have deferred tax liability and deferred tax asset at the same time. Remember, if the two items are present, so you have deferred tax liability and deferred tax asset at the same time, you cannot offset it. So you will present it separately. Then you have two answers. You have your tax expense and at the same time, tax benefit. Okay? We will discuss more examples when we meet next meeting that will be on Friday.